Okay, now let's look at real estate because that's an important part of this picture and something we've been very, very accurate in warning people on in our past books and in our newsletter. Real estate has a number of things, but the most important ones are the offices and commercial real estate. Hold on a minute, I've got something here. That come when people enter the workforce, and then apartments and shopping centers when they get married, starter homes, as we saw the boom in the 80s was driven by that. And then this recent boom was trade-up homes and vacation homes. And trade-up home buying does peak ahead of the peak in spending between 46 and 50, and the first peak of vacation home buying. So it's important to note that baby boomers have already peaked in their total home buying for residential. In other words, their trade-up homes is done. They're not going to be spending more on that forever, and the next generation is going to be decades before they come to that. They're in the first phase of the vacation home buying, peaks in the mid to late 40s. That's where the most speculation is, so that's the most overvalued, and that's getting ready to turn down the demand for that strongly by 2009-10. Then there's a second wave of vacation home buying in the late 50s and early 60s. So that will be good for the future, but the largest generation history has peaked in their home buying. And so that means we moved sideways and down for a long time, just like happened in Japan in the 1990s. And where the real demand is going to be in the future is going to be apartments in the near term, and starting about early to mid next decade, starter homes for the next generation. So real estate's going to change, but real estate is at the heart of this bubble, the largest bubble we've ever seen, and that's what the next slide shows from Robert Schiller. Home prices, when you adjust for quality and size, do not go up with the economy or earnings like stock. They basically go up with replacement cost and inflation over time, and they've been flat when you adjust for inflation and size and quality until this incredible bubble from 2000 to 2005. The greatest bubble in history in housing has occurred, and it was part of this whole bubble boom thing where we had a tech bubble, and when that deflated in the early 2000s, and interest rates went low, people just speculated, borrowed money, and they invested in real estate to get another way to keep the returns coming. And now as the housing bubble has been busting in the last several years, the money's been going into commodities and emerging markets. So it's bubble after bubble. But the important point, this real estate bubble has to go down about 50% for the average home price just to get back to where it should be long term. So this is the housing slowdown is not over. This is going to take many years. We look back at Japan for reality. The bubble there really started. Home prices had gone up there for decades, just like here, but the bubble phase really started around 1985-86, went extreme into 1991, and then deflated back to where the bubble started. That's classic. Home prices down 60% in Tokyo. From 91 to 2005, and condominium prices down 70%. So bubbles do deflate even in housing. When we look in the United States, if we go back to where the bubble started somewhere between 96 and 2000, or really the stretch of 2002, we're talking a 45 to 65% correction. Now, this is in the average home price. This is not in Florida or California or New York or Vancouver. This is everyday home prices. So that's a big drop. We are going to deflate back to where housing prices should be long term. It's going to be painful, but it's going to be a huge boon to the next generation coming along. They're going to be buying home prices at half the price we did, and with mortgage rates as low as 4%. Now, other cycles that are important, Decennial cycle, the early parts of most decades is weak. This cycle turns down typically from around mid to late 2009 to around mid-2012. Investors and businesses and real estate developers should be cautious in the early years of the decade, even beyond our major peaks in commodity and demographic cycles. This is a very consistent cycle. The strongest booms happen typically in the second half of the decade. And then, of course, the regular 4-year cycle. Stocks tend to take corrections into midterm elections about every 4 years. The next cycle down due is mid to late 2009 to mid to late 2010. Now, here's an important point. If we look at all of our cycles, and a lot of the ones we describe in the book we're not describing here because we don't have the time, but the period where we have all cycles down is mid to late 2009 to late 2010. That is the most dangerous period. So what that tells us is much damage as we've seen to the stock market and housing in the economy here in 2008, we've still got the worst of the storm ahead of us. So the degree we do recover in the second half of this year and stocks do bounce and housing prices at least loosen up some or flatten or maybe come back a little bit, we're going to see an opportunity for investors to get back out at decent prices before the worst of this storms come. And, of course, most people are going to think the government saved the day and it's over, and it will not be. We'll give you that as about as near a promise as we can give in our business. The weekly leading index has been saying of recent that, yes, this is going to be more serious. Earlier in 2008, this projects forward about 7 months. It was saying, hey, we're going to have a normal recession into maybe September or so, and now it's saying, no, as we go into mid-next year, we're going to see the worst recession we've seen since the 70s and 80s, and probably worse than that. But this indicator is just starting to turn up. We hope it will continue to with the bounce in stocks and some other indicators. But again, if you look at it, the next slide compared to past recessions, you can see this is going to be stronger than 1990 or 2000, 2001 downturns. Volatility in stocks, normally when the VIX, when it gets towards around 50, it's a slam dunk for buying stocks as a 98 and in 2001 and 2002, but this time it's gone even more extreme. Again, it shows we're going into something of a much greater degree, more like the 1930s than other downturns we've had. But it also says this recent bottom in November, in October, November in stocks is probably a bottom for now. We're probably going to bounce into this year. We show here in the next chart, the monetary base is growing most rapidly it ever has, and we're just starting the stimulus program. There's much more planned, 500 to 700 billion from Obama coming in, continued spending of this money the government set aside for the banking system and for companies and bailouts and stuff. This is the most massive stimulus plan. The government had nowhere near this response in the Great Depression. They had a different philosophy back then. If we look at it very short term, it's even more dramatic. And I just saw a graph this morning. The Fed's balance sheet has almost tripled just here recently. So this is why we favor scenario one. With this massive a stimulus, I mean, it literally, we kind of joke, it would be like taking a bottle of Viagra and having nothing happen. I mean, yes, we have deflation. Yes, we have this meltdown and credit gets destroyed very quickly because banks are leveraged 10 to 1 on their capital and their lending. But the government has pretty much said we're going to do whatever it takes to stop this. So we think we are going to eventually get a rebound, and that means stocks are going to rebound at first, and it means commodities are going to rebound longer. There will come a point where the rise in commodities and the rise in interest rates and inflation rates start to work against stocks, because stocks don't like any of those things. Stocks are just earnings adjusted for inflation, interest rates, and things like that, and oil prices, and commodities will keep going up.